Coming up next, we have the incredible Ben Henry Moreland. He's going to break down tax planning versus tax advice in a way that's clear, smart, and seriously helpful. He is the senior financial planning nerd at kitsies.com. Prior to that, he ran his own IRA and he specialized in financial planning and tax prep. So he is perfectly positioned to deliver this presentation. Ben, come on down to the stage. Hey,
Hello.
Ben, happy to have
Hello,
you.
everyone. Yeah, thank you so much for everyone for being here and Laura and Liz Plan for having me today.
All right. I'll hand it off to you. Thanks, Ben.
All right, thank you. And I second Jeff. The hold music during the break was a real banger. I was doing a little solo dance party here by myself as that was going on. But our main topic here today is to talk about tax planning. This is one of the biggest questions, the most common questions I get from advisors, particularly as tax planning tools, things like Plan, have come about increasingly over the last few years, really aimed at um, helping advisors be able to do more tax services for their clients. And so I get this question a lot of what can advisors do around taxes? Can we give tax advice? I thought we can't give tax advice. What is tax planning? Is it different from tax advice? There's not a lot of real simple answers here, unfortunately. This is the first part. The first challenge we have to overcome is there's not a very clearly defined barrier between the two and what advisors can and can't do. And so I want to talk today about how do we set that barrier? Where is the line between what advisors can or should do and what they can't do? What are they? What are the concerns about doing it? How can advisors give ultimately have productive and valuable conversations with their clients around taxes? And so without further ado, I'm not going to turn off my video, but I'm going to share my screen here to start our presentation around, here it is, tax planning versus tax advice. And I want to start out today with a little story about early in my career as a financial advisor. I was kind of working as sort of a lowly paraplanner at a wealth management firm, and I would go into meetings with one of the senior wealth managers and mostly just take notes and absorb what was going on in these conversations. And one of my first meetings there, I went into this meeting with a client who was recently retired, and the wealth manager is talking with them and saying, well, you're retired now, you don't have very much taxable income, you're in a pretty low tax bracket. It might be time to consider doing a Roth conversion. You have a lot of money in pre-tax retirement accounts, and so if you take some of that and convert it into Roth at now that you're at a lower tax rate, lower tax bracket, you can pay tax on that now and never have to pay tax on it again, since it'll be in a Roth account. And you do some of the analysis and compare some of the numbers before and after the conversion, and it's looking pretty good for doing the Roth conversion. But then the wealth manager stops and says, but just to be clear, nothing I'm saying here, I'm not giving tax advice. You need to run this by your CPA to decide whether or not you actually want to do this. And that was interesting to me as a young advisor hearing that, because here I was thinking, oh, we're making a recommendation to do these Roth conversions, right? And it's just about Roth conversion. So it's literally just about doing taxes. There's no other reason to do a Roth conversion other than to save taxes. So how is this not tax advice? And so after the meeting, I go to the wealth manager and say, hey, why did you say that about we're not giving tax advice here? And he tells me, well, we can't give tax advice. Only CPAs can do the tax advice. So that has to come from the client CPA. And so I thought, all right, I guess that makes sense. I knew that lawyers can't give legal advice, or sorry, only lawyers can give legal advice. Non-lawyers cannot give legal advice. So I thought maybe, yeah, there must be some similar rule about you can't give tax advice if you're not a CPA. So I kind of went on in my career as I was starting out and starting to get my own clients and having conversations with other advisors around what they were doing, and kind of internalized this idea that financial advisors can't give tax advice. Except as I was having some of these conversations with clients and other advisors, I was thinking about how much of our advice that we're giving as financial advisors, how many of these conversations are really about taxes, not just Roth conversions, but we're talking about things like portfolio management strategies, how to make clients' portfolios more tax efficient. We're also talking about things like charitable donation strategies. We're talking about the SALT deduction that Jeff just talked a lot about in this last bill, and how we're doing that around the SALT cap in the last 7 or 8 years. And we're talking about stock option exercise, and all these different conversations that we're having with clients that are about taxes ultimately, and realizing that you're not really giving tax advice at all if you're not really giving financial advice at all if you're not also giving some sort of tax advice. And it sort of dawned on me that this idea that financial advisors can't legally give tax advice is kind of a myth, because I realized that, hey, we're all sort of doing this, looking around and talking to other advisors like, hey, we're recommending clients do these Roth conversions and things. How is that not tax advice? Even if we're saying, oh, we're not giving tax advice. We're doing this, but we're also not getting, cracked down on by the IRS. No one's coming and knocking on our doors and saying, did you tell that client they can do a Roth conversion without having a CPA license? No, no one's doing that. So it's a little bit of a myth that we're saying financial advisors can't legally give tax advice. Here's what is the reality, is that whatever we're doing with our clients, whatever advice that we're giving, almost any recommendation that we're going to give has some tax consequences. Even if we're not saying, here are the tax consequences, if we're saying, client, do this or that, it's going to have some kind of a tax impact on their life. And so if we're not talking about it as advisors and just ignoring the tax impact of our advice, we're not really acting in our fiduciary capacity. Because if we're not thinking about the tax impact of our advice, some of these recommendations we could be doing could have really disastrous tax impacts for, maybe not disastrous, but pretty significant tax impacts for our clients. Thinking about transitioning to a new portfolio and saying you've got all these securities with all this single company stock that's highly appreciated, and I think you should diversify and go into this portfolio instead. And so they sell all their stock and then incur a giant capital gains tax bill and say, hey, what was that? So are we really acting in our fiduciary capacity for clients if we're not talking about taxes? And I think no, it's very hard to do that. And so then how do we actually talk about this stuff with clients? So we're making sure that we are acknowledging the tax impact of our advice, making sure that we are doing right by our clients with their taxes, but also making sure that we're protecting ourselves both legally, and I'll talk about a little bit later with financial liability. How do we actually do that? Where do we set that line for us and for our clients? Now, why do we want to give tax advice or make tax recommendations to clients? As I mentioned, it's hard at a base level to do that and still fulfill our fiduciary duty, but also there's more reasons. These tax strategies can add real value for the clients. It's not just about avoiding negative tax consequences. It's also about adding real positive tax value for clients with tax planning strategies. Now, there have been some studies trying to quantify some of the values, put some numbers on what some of these tax strategies actually mean to clients. One of the most famous is Vanguard, and some of their Advisor Alpha research has put a number of 60 basis points per year just in sort of after-tax return coming from just asset location. So putting different types of assets into the most tax efficient type of account for those assets. You think about putting maybe some taxable bonds into a tax deferred account, so the client isn't paying taxes on that income every year. That type of asset location, 60 basis points a year of the assets in those accounts. Tax loss harvesting, again, in taxable accounts, taking assets that are at a loss and selling them to capture that taxable loss to offset income from taxable gain income. More studies on that. Financial Analyst Journal put a number of up to around 100 basis points of, again, after-tax value just from doing tax loss harvesting. So if you look at those two strategies combined, just asset location, tax loss harvesting, just doing some tax-friendly, tax-efficient portfolio management can almost add up to the total amount of the advisor's fee every year. It really has significant value. And then you get more strategies beyond just the portfolio. You get tax timing decisions. And this is where you get into the Roth versus traditional stuff. Do I pay taxes now at my current tax rate by putting money in a Roth, or do I pay taxes later on when I withdraw the money by putting it in a traditional account? When do I convert assets from one to another to capture the most tax value? You think of someone who's at a very high tax bracket, up at the 37% tax bracket, and maybe has another, 5 to 10% in state taxes on top of that. The difference between that and paying after retirement down at the 12% or 24% tax bracket, they could be saving 10, 20, 30% in federal taxes and maybe another 10% in state taxes by just timing the income right. So huge value potential there. Other sort of year-to-year sort of tax decisions based on whatever the client situation is. Maybe they're someone who's an employee who gets a lot of equity compensation, so they talk stock option timing decisions. Maybe they're a business owner who they're talking about things like, do I choose an LLC structure or an S corp structure to run my business? Planning around the QBI deduction, as we talked about in the last session. So all these sort of day-to-day tax decisions have big impacts on clients' lives. And then finally, a more priceless service we can offer as financial advisors. We are the people who often know our clients' financial lives the best. CPAs don't always have all the information available. They ask for a lot of information when they're putting together their clients' tax returns, but sometimes even then things can slip through the cracks. So having the ability to look at, review a client's tax returns, either see opportunities or maybe catch things that the CPA might have missed, really a priceless service that we can offer to our clients. And if you step back and think about how we demonstrate our value as advisors to clients, we can look at what they do investment wise. But it's a little bit harder to really define and quantify the value that we bring around investing because we don't necessarily know from hindsight what a client would have done if they had not followed our investment recommendations. It's very hard to tell. And if we say, oh, the clients, you made money in the stock market this year because the market went up, look what I did for you, an advisor. You also have to own any of the market downturns as well. So you don't necessarily want to stake tons of your value and try to quantify a real number around investments. But it's a little bit different from taxes because you can literally often see the number on the tax return and compare, what happens if the client does X strategy versus Y strategy and how much they would have paid in taxes and be like, yeah, there's the value I provided there as an advisor. So very much easier to sort of in a concrete way demonstrate your value as an advisor through tax planning. So the big question then is, how do you provide all this value through great tax planning, great tax strategies? How do you do this if you're not allowed to give tax advice? Well, in my opinion, advisors really can give tax advice. And what I think of as sort of real tax advice, which I will get into in a little bit here. First, I want to tackle this idea that only sort of a CPA can give tax advice. And there is some truth that there are things that only credentialed tax practitioners, by which I mean CPAs, certified public accountants, as well as IRS enrolled agents, EAs, and attorneys as well, what these certified or credentialed tax practitioners can do that just not everyone else can do. And they have what is known as unlimited practice rights before the IRS. And the IRS lays this out in what a document called Treasury Department Circular 230 that governs a lot of the obligations of tax practitioners. And so what CPAs, EAs, and attorneys can do, it's a number of things. They can correspond with the IRS and represent taxpayers on behalf of clients in front of the IRS. If the client gets audited on their tax return, only someone who's one of these credentialed tax professionals can do things like represent the client to IRS agents and appeals officers and sign off on letters of compromise and all those sorts of representation matters. But they also say that only these, I should say, Circular 230 also says that only these tax practitioners can render written tax advice. And that's, of course, what matters most to financial advisors, most of us are not, CPA, EA, or attorney. If it says, okay, we can't render written tax advice, I guess that's sort of straightforward. We just can't give tax advice, right? Well, this would be a much shorter presentation if that were the case, but when you actually look at how the IRS defines tax advice, it's actually a little bit more nuanced when you think of what they're talking about. So this definition from Circular 230 says tax advice is defined as the rendering of written advice with respect to any entity, transaction, plan, or arrangement, or other plan or arrangement having a potential for tax avoidance or evasion. It's that last part that's the key part, having a potential for tax avoidance or evasion. The IRS is really concerned about people recommending strategies that have the potential for abuse, either straightforwardly illegal tax evasion that actually hides income or obscures it in some way. So in a way to sort of illegally reduce someone's tax burden, or tax avoidance, where you're maybe doing something that could be straightforwardly or could be I guess technically within the bounds of written law, but maybe violates some spirit of the law, and also reduces the tax burden of the client in some way that the IRS sees as having the potential for abuse. And that is really the thing that I think defines what the IRS considers tax advice, is that it has some potential for abuse, whether through tax avoidance or tax evasion. So you think of tax shelters, abusive sort of tax shelters, LLC structures and things designed to hide income. The IRS wants to know who's using them, and they want to know which advisors are recommending them. IRS literally keeps lists of transactions called listed transactions, or transactions of interest, that require disclosure by anyone using them. You do one of these listed transactions, you have to file a form with your tax return saying, I did this listed transaction, and also include anyone who might have recommended that policy or that strategy to you. So they really want to know who is recommending this stuff as well. The IRS, they send out their list of dirty dozen tax scams and avoidance schemes, where you see a lot of these listed transactions, these things that they see as having potential for abuse. You see things like syndicated conservation easements, you see micro-captive insurance plans, you see a lot of these different sort of complex structures designed to, maybe hide some income or reduce income in a way that maybe, if you look at it from a certain angle, follows the strict letter of tax law, but the IRS really sees as having the potential for a lot of abuse. That is what the IRS treats as tax advice. Now, what I see advisors give on a day-to-day basis, particularly the fiduciary advisors, the RIAs, the people who are CFPs, is a lot different from that. It is the Roth conversions. It is things like donation strategies of appreciated securities. It is things like tax loss harvesting. It is those business entity elections. Those are the things that I see so many advisors do on a day-to-day basis, and that is a lot different from these potentially abusive tax schemes, tax shelters, and things that the IRS really wants to look at. So when you look at what advisors do on a day-to-day basis, often just straightforwardly legal strategies to minimize a client's taxes. That is okay from an IRS tax perspective. You see things like Roth conversions, like asset location gains, capital tax loss harvesting, as well as gains harvesting. You realize, capture some capital gains while the client's in the 0% tax bracket. Itemized deduction strategies, maybe lump some deductions together so a client is able to take advantage of itemizing. You get stock option exercise conversations. All these kind of things are very straightforwardly within tax law, commonly practiced things that don't have any issue with the IRS. I've never seen someone doing any of these sort of strategies have the IRS come and knock on their door and say, you can't be doing this because you're not a CPA or an EA or an attorney. Then you get the other types of transactions, the abusive tax shelters, those listed transactions of interest, the dirty dozen kind of stuff. That is where the IRS says, nope, you cannot do that. That is where people can get in trouble, and often do get in trouble, sort of regardless of whether they're actually a credentialed tax practitioner, because some of these things are, again, some spicy interpretations of tax law. So people can get in trouble with those regardless, but you really don't want to do that if you are not a credentialed tax practitioner. So that really means that there are kind of two types of tax advice. When we're talking about tax advice, what is tax advice? We're talking about two different things here. We're talking about either those tax strategies with the potential for tax avoidance, for tax evasions, the things that the IRS sees as having the potential for abuse. And that's kind of what I call the IRS tax advice, because it's the IRS who really cares about people who are doing that. And to the extent that you're recommending those strategies, or anyone recommends those strategies, they need to be a credentialed tax practitioner, because that is within what Circular 230 says is written tax advice that only those practitioners can do. And again, in most cases, people shouldn't be recommending those strategies anyway, because they often are abusive and can get people in trouble regardless. But still, within the written definition of Circular 230, you need to be a credentialed tax practitioner to recommend those kind of strategies. The real tax advice, those without the potential for tax avoidance, for tax evasion, for abuse, those are what are considered I consider what's sort of the real tax advice, the thing that fiduciary advisors do and that they don't tend to get in trouble at all from the IRS about. I've never talked to anyone. If you, I always ask this in doing this presentation, if you ever heard of a advisor getting cracked down on the IRS for recommending a Roth conversion or for doing tax loss harvesting, please let me know. I've never had anyone email me and tell me about it. So next time would be the first. I'm not saying it could never ever happen, but so far it just does not seem that that is a priority. The IRS really wants to know who is recommending abusive tax shelters, abusive tax schemes. They don't care about advisors recommending things that are just straightforwardly within the definition of tax law. So then the bigger question for me, I asked about at the beginning about, hey, how can advisors provide value around tax advice if they're not legally allowed to give advice? Well, the question kind of changes then now. I think the bigger question is then, if advisors are legally allowed to give tax advice, or if it's at least something that the IRS doesn't come and crack down on them anyway, why are so many advisors told that they can't? Why is there this idea that, oh, we just can't give tax advice as an advisor? So the answer in a word here is liability. The legal and professional liability we take on from giving advice. Anytime a financial advisor, someone who's a trusted professional, gives a recommendation, they are liable and accountable for the advice that they give. So if it leads to some financial damage for an investment side, the advisor recommends an investment and the investment turns out not appropriate for them and loses value, the client loses money, the client goes and sues, the advisors can be held liable if if the courts or the arbitrator, whoever's deciding the case, decides that the advisor sort of violated their requirement to do well by the client. And so the same applies to any tax advice. If a recommendation from the advisor ends up in, ends with the client owing taxes, penalties, some sort of tax liability, the advisor and the firm can be held liable for that damage. And so the way that RIAs sort of came about and how they're regulated was up through the investment industry. Advisors typically didn't do anything around taxes until relatively recently. And so the regulatory regime that built up for advisors over time was all around investments, the registered investment advisors. And so the SEC and state regulators started to require advisory firms to have policies and procedures in place to make sure that their advisors were giving advice that was in their client's best interest, that they weren't doing fraud or doing anything that was not in their client's best interest, and setting up ways for advisory firms to supervise their advisors, et cetera. But this was all around investment advice. It has nothing to do with tax advice as it's set up right now in the current regulatory structure. So the policies and procedures that RAs have in place today don't cover tax advice. They only cover investment advice. So there's no set way for RIA firms to supervise and manage their advisors around tax advice, just because they're not required to. Similarly, professional liability policies, errors and omissions, E&O policies, insurance policies that advisory firms usually have in place, they cover losses from investment advice. Again, a client sues an advisor regarding an investment recommendation, and they're required to pay the client back in some way. The advisor's E&O policy will pay those damages. Will cover that liability for the advisor. But a lot of these policies don't cover damages from tax advice. If that same situation happens with a tax recommendation, oftentimes that E&O policy is not going to pay out for the advisor. And so advisory firms are both not set up to supervise or regulate and have compliance for their advisors around tax advice. They're not covered from liability standpoints to give tax advice at all. And so a lot of these firms, particularly the bigger firms with a lot of advisors to regulate and to supervise, take what's kind of a lowest common denominator approach. They say, what could my least competent advisor of all the thousands of advisors for my company, what could they do to get me sued? And then they set their policies around that. So in that case, that's what led to so many, particularly a lot of the biggest firms, the wirehouses, et cetera, to say, we just don't do tax advice at all. We can't do it because it could get us sued. We don't have the policies in place. We don't have the insurance coverage to cover it. We just don't want to supervise every single advisor that we have to make sure that they're giving good tax recommendations. That's just not what we're set up to do. So that's why we see so many advisors saying we just can't give tax advice, or so many being told that they can't give tax advice, not because they're not allowed to from a legal standpoint, but because they are, in doing so, they may incur some liability for their firm that the firm doesn't want to take on. So again, we have potential tax practitioners who can give that tax advice, but it doesn't really matter whether they're a credentialed tax practitioner or not. For most cases, when they're giving just the real tax advice, the sort of everyday, straightforward legal tax advice, they don't necessarily need to be credentialed. The only difference is that if it's a credentialed tax practitioner, they can give that sort of, I mean, they can do all the other representation stuff for their clients. So if they will really want to do tax returns for their clients and really want to be able to represent clients and toward the IRS, they do need to be that credentialed tax practitioner. But if it's just around tax advice, they can do that as long as they're not doing the abusive sort of tax schemes, tax avoidance strategies that they probably don't want to be doing anyway. So what really matters is what kind of firm that they're working for. The advisors who are solo advisors, who are at maybe a small enough firm that they have some say in the type of advice that they give, a lot of those can give tax advice and do, because they are aware of the liability that they're taking on. They own that liability for doing it, and they can decide whether or not they want to take that on for themselves. It's often different at larger firms. The bigger the firm you get, the more likely it is there's going to be some sort of limitation on the type of advice that they give based on what the home office or the firm-wide policies say that they can do. So you see, maybe a lot of these solo or smaller firm advisors being able to give any sort of, again, what I call the real tax advice, but then you see a lot of the larger firm advisors who are not able to give that advice. So I want to talk to both groups here for the rest of this presentation. For the ones who do and can give sort of that real tax advice, talk about what that sort of is and what that means, and talk about how you can protect yourself and make sure that you're at least accounting for the liability that you're taking on, because that's the important consideration you want to have if you are giving tax advice, to say, how do I protect myself so I can be accountable for the advice that I give. For a larger firm advisor, or for someone who either doesn't want to or can't take on the liability of giving tax advice, I want to talk a little bit about what you can do to still have some conversations with clients around taxes, be able to still give some value around taxes for your clients without actually giving tax advice. So let's start with talking about, if you do want to give tax advice, offering this real tax advice as a financial advisor, if you can or are allowed to or want to give this tax advice, what do you need to do? Well, to start out, you need to know when you're giving tax advice. What does it actually mean to give tax advice? And surprisingly, there's not really a great formal definition of this other than that IRS one that I gave earlier, which again, really only covers and applies to these sort of abusive tax shelters. But what's the rest of the advice out there? How do you know you're actually giving it? So I have kind of a two-part rule of thumb for this. It's obviously, at a bare minimum, you're giving a recommendation, right? That's the core of giving advice, is you're saying, here's the thing that you should be doing. But it's also, I think, important to have a plan of action, to say, not only here's the thing you should be doing, but here's how you should actually do it. Because then you're really actually giving the client the tools to act on what they're doing, rather than just giving a broad sense of, maybe this would be a good idea. So I think giving advice should entail both a recommendation and a plan of action. And you're giving advice when you're doing those two things. You might have a little difference of opinion. You might really only say it's just the recommendation that matters. It can, I think, sway a little bit depending on difference of opinion. But you ask me, there's, I think, really just those two components of having a recommendation, having a plan of action that you're giving to the client. And that is when you're giving advice and taking on the liability for giving advice. And that, I think that also applies to, if you're worried about giving tax advice, if you don't want to give tax advice, I think those are the things you want to avoid doing, right? You want to make sure you're not giving a specific recommendation. You want to make sure you're not laying out a plan of action for the client. So it works both ways. And to me, that is the line between the two. So I think next, if you're deciding you're wanting to give tax advice, the next thing you want to do is making sure you're defining the scope of that advice. So you're not hitting on that sort of IRS tax advice, those sort of abusive schemes that the IRS wants you to have to be a credentialed tax practitioner for. So obviously there, it's just recommending those abusive tax shelters. And the link here has the link to the listed transactions. You can just Google listed transactions from the IRS as well to find out what those all are. It's a pretty long list, so you can kind of do some digging into the fun and creative ways that people have found to illegally or semi-legally avoid taxes over the years. I would also make sure to avoid trying to interpret tax law, particularly in some sort of novel way. The IRS, even if it's not something that's on the list of listed transactions, doesn't mean it's something that the IRS wouldn't find potentially abusive. They're always wanting to know who's like looking for sort of the next big tax shelter as well. So making sure that you're sticking with things that are really straightforwardly within the definition of tax law and not interpreting it in any sort of novel way as well. And finally, something I would really avoid if you are wanting to give tax advice, if you're not a CPA or an EA or attorney, is giving some written opinion on the legality of something, a strategy. If a client comes to you and says like, "Hey, I heard someone pitch this conservation easement idea. Can you tell me whether that's actually legal or something, something that's getting me in trouble or not?" Like that is really the purview of, like, we're almost getting into legal advice there, where you'd want to have an attorney involved. But at the bare minimum, having a CPA offer that opinion rather than as a financial advisor who doesn't have that credential. That would really help keep you from being within that sort of IRS bad version of tax advice, and just staying within the everyday sort of real tax advice that you're giving. So once you're deciding what tax advice to give, what the scope of that you want to be, you got to manage that liability exposure then. Again, knowing that if you're giving advice, you need to be accountable for that advice. And oftentimes in a financial way, not every recommendation, unfortunately, pans out as anticipated. Mistakes happen. And so sometimes, you do need to make sure that you're protected from that liability exposure. And obviously the first place to start is from the top and making sure that you're giving advice that you're qualified to give. The best way to not have tax strategies blow up is to make sure that you're well educated on the type of tax strategies that you're recommending, and making sure maybe you have some types of tax recommendations that you're comfortable giving and are happy to give advice on, but there may be others that you're not, and you decide, okay, I need to either get more education, do more research before I can recommend in these other areas as well. So just, that's the biggest part of avoiding liability, is just making sure that you're recommending the right strategies for clients. And that requires some education, some research, making sure that you know which areas that you're giving advice in, that you're competent in those areas. Disclosure, it's not just about putting a thing in your email or on your recommendation saying, "Oh, this is not construed as tax advice, consult your CPA." It's about more than that. It's about really making sure that clients know what you're recommending, and that it may have risks, that it may not pan out as anticipated. And what that means is often, go back here. What that means is often being very upfront with clients when you're starting, when you're giving these recommendations, just as you would, I think, with investment recommendations, making sure that they know that, hey, there's no guarantees with this. Same is true with taxes as well. Just making sure the clients understand and are aware of the risks that they may be taking with tax strategies. Making sure that if you are, giving a recommendation and saying that you're going to do this for a client, making sure that you actually follow through with it as well. There was a case a couple of years ago where an advisor recommended a client do a series of Roth conversions and say, okay, we'll do these Roth conversions for you in year 1, 2, 3, 4, and 5. And they did the conversion in year 1, and the client paid taxes on it, and it was fine. And then in year 2, they didn't do the conversion on. And the client assumed that they were going to do this conversion, so the client paid a bunch of estimated taxes that they didn't end up actually owing in the end. And the client wasn't happy with this. So they sued their advisor to actually follow through with the plan that they had agreed on. And I think that got settled out of court. So I don't know what exactly the result was, but it's a good reminder that, when you as an advisor are saying, this is the plan, this is what we're going to do, you also need to follow through on that advice. And finally, as a last resort, there's that E&O coverage. There's that errors and omissions insurance policy. Again, that is kind of the final line of defense against liability exposure. All those other things on top of just making sure that you don't get yourself in a position where you are taking on liability to begin with are going to reduce your need to rely on that E&O coverage to pay out in the event of a judgment or damages against you. But because there are always things we can't predict, it's still good to have that final backstop in place of E&O coverage. So some plans, they do offer riders for tax advice, tax preparation that they can add to that policy. So if you don't know whether your firm's E&O policy does have coverage for tax preparation, contact the insurance company, see if they offer the rider, make sure that you're covered if you are giving tax advice. So switching gears a little bit to what you need to do, what you want to do if you can't give tax advice or don't want to give tax advice and take on that sort of liability exposure of offering tax advice. And again, this is not just about, am I a CPA or not? This is about, does my firm allow me to do this, or do I as an advisor want to take on the liability of giving tax advice? This is the crucial distinction here. So how do we define tax planning? This is the world that we're sort of in when we're not doing tax advice, is we get into this sort of murkier area of tax planning. So what is tax planning? So if you look at it in the context of what you're doing as an advisor when you're giving any sort of advice, there is sort of a planning stage and an advice stage and an implementation stage. So when you're in the planning stage is when you're sort of analyzing these ideas. You're looking forward, you're maybe providing some information, you're putting together plans that are sort of malleable, things that might change in the future. This is planning. Plans change often. And so you're doing things that are looking forward. So what does this mean in the context of tax planning? You're running the numbers. You're running it through your Holistiplan or your financial planning software, looking at projections for the future, saying, okay, if we did this strategy, here is what it would look like with X versus Y. You're not coming down to the point of saying this is what you should do, because that is where you get into advice. Once you get into advice, it is about action. It's about saying this is the thing that you should do, and here's when you're going to do it. Again, having that you should do this, and here's how you do it. But also, I think advice tends to be more actionable, tends to be more about, we're doing this, we're going forward with it. It's often much more immediate rather than forward-looking, like planning is. It's saying, okay, we're going to do this Roth conversion now. Sign this paperwork, and we will get started with it. Or it's often concrete. It's often just the numbers are what they are once you actually finally make advice, and it's hard to go back and change them most of the time. So that is where you start to incur liability as an advisor. And then, of course, you get into the implementation phase. You are actually following through on the advice and in whatever way you've agreed to do so. And that's where you need processes. You need to have organization, good communication with your clients to make sure you're following through on this implementation stage. But when you're just doing tax planning, you're not doing this advice or this implementation section. You're just focusing on this planning part, this forward-looking, more changeable portion of the advice. And so what I would really define tax planning as then is you're factoring the tax impact of the client's actions on their own financial picture. So you are really just looking for tax impact on a client's financial plan. You're maybe doing multiple scenarios and comparing them, but you're not coming to the point of saying, this is the thing that you should do, and here's how you should do it. So I would kind of have an analogy of this as of it's sort of like you're building a house. So say you decide you're going to build a house. You're going to start out, buy a plot of land and decide what you want this house to look like. And your planning phase of that is maybe you start to decide, what you want the shape of this house to look like, what color you want it to be, what you want some of the finishes to look like. You hire maybe a designer to make a sort of concept drawing of it. It's all, how you want this plan to look like. And but a lot of it is still changeable at this point. What the house isn't necessarily going to look exactly like it is in the concept drawing. It's just saying, here's what I want this to look like. When you get into the advice part, that's when you're actually hiring an architect and building blueprints and or drawing blueprints and saying, this is specifically how this house is going to be laid out and designed. And that that architect is taking on some liability. If they say, you're going to build the house in some way, here's the design, here's the blueprints, go for it, and then the house falls down because it's not designed well, like that architect is going to take on some liability. That architect is going to be sued for the plan that they drew. It's the same for giving advice in a tax context. It's when you're actually making those concrete plans that you're starting to take on liability. And then the implementation, you hire a builder, they build the house. Again, that's a whole set of different considerations. But those are sort of the three phases that we're looking at. And so I want to focus just on this planning component here right now to talk about where we're doing. And I want to do that in a few case studies, because then I realize I've been a little bit broad in how I'm defining this. So I want to talk through maybe a couple case studies to hopefully make this a little bit concrete. And I'm going to start with Roth conversions. I've been talking about this a lot because I know that's what a lot of advisors like to do. That's a real core tax planning strategy for so many advisors and their clients. So let's start with, maybe you've got a client coming in. They are retiring in the next year or so. They're going to be in a lower tax bracket. Maybe they're up in the 37% bracket, or even not quite there, maybe in the 35%. But they're still in a high tax bracket right now. But in a year or so, they're going to be retired. They're not going to be having any income. They're not going to have any Social Security coming in yet, any RMDs coming in yet. So they're going to be in a low tax bracket in a couple of years. So you are planning on saying, hey, maybe it would be a good idea to start doing some Roth conversions once you get into this lower tax bracket. Do a series of those over, maybe 5 or 6 years until Social Security kicks in, and take advantage of those low tax brackets they're going to be in. So what does that look like from a planning, advice, and implementation standpoint? If you want to just focus on tax planning, this means you're probably plugging numbers into your financial planning software or your tax planning software, and looking at what the client situation is right now, maybe taking their tax return right now, and coming up with a projection of what their current situation looks like, maybe what they would do in a few different scenarios if they converted 10,000 a year or 50,000 a year or $100,000 a year. Coming up with sort of ballpark figures of where it would look best for them to make a conversion. This is all, again, it's very forward looking. None of this is happening today. They haven't even retired yet. This is going to be next year. So again, likewise, a lot of this can change. A lot of these plans, if something comes up in the future, the client gets another unexpected source of income, they decide not to retire overall. No one's making plans that can't be changed yet. So this is just a forward-looking projection. And so this is where you're really within the realm of tax planning. You're running those numbers. You maybe come up with some ballpark numbers. Say, hey, 50,000, 70,000. You're not saying, oh, you're going to convert $74,236 in to fill up your tax brackets here. You're just giving ballpark figures here. That is the planning side. And that still provides a lot of value for clients because it gives them something to start with. Say, hey, I think I'm going to be doing some Roth conversions, and here's about how much it's going to be. So here's what I need to plan on for my tax impact. Like, it gives some plans, and you can provide, I think, a lot of value in just doing that planning for the client because it gives them a place to start with. before they get into the advice part. And so when you get into the advice part, that's when you start to calculate real specific amounts. You say, okay, here's how much, once you get into the year that the client actually retires and you get closer for them to actually make this Roth conversion, you start calculating specific amounts. And maybe you're doing this as the advisor, um, and um, and running these numbers through your system, but that is really starting to get into the advice side. Otherwise, maybe maybe you're calculating these numbers, but saying, hey, we should loop your CPA in here to confirm these numbers, make sure there's nothing we're missing here, and have that collaboration happening to make sure that the advice part is being covered by someone who is willing and able to take on the liability for the advice. And then finally, there's the implementations. There's the actual moving the money from traditional to Roth. Even if you're just doing the planning and having the CPA, sign off on the strategy for the advice section, maybe that implementation comes back to you as the advisor to actually move the money there. And also you need to make sure it's reported correctly. That might involve some more collaboration with the CPA. So really 3 distinct stages here. But if you just want to stick with the planning part, you can do so just by running those numbers, coming up with some sort of ballpark figures, and giving a starting place to then fill in the real specifics that come in the advice part. So similarly, if we're talking about backdoor Roth contributions, it's a popular strategy for higher income individuals. If they want to put some money in a Roth account, but have too high income, their income's too high to make a direct Roth contribution, they can put some money in a traditional IRA, make it non-deductible, and then convert some of that, or convert those dollars into Roth, known generally colloquially as a backdoor Roth contribution. So again, this is a situation where there's steps of planning and advice and implementation. So what does the planning look like with a backdoor Roth? Well, it's just deciding, do you want this money in Roth? Do you want this, $7,000 a year that you can put into a backdoor Roth, because that's the actual like IRA contribution limit? Do you want this? Should this be in Roth? Does it make sense for it to be there? Comparing the effects, the Roth versus non-Roth allocation of that money. The advice part of it this is where you get into the actual kind of nuts and bolts of doing backdoor Roths, because a lot of people are concerned about, if you do this sort of strategy and take money and put it in a traditional IRA and then convert it to Roth, is the IRS going to come and say, hey, this is what's called the step transition, or the step transaction doctrine, where they can say, actually, we're going to combine those and treat it as if you had just made a direct Roth contribution, and because your income is too high for that, we're going to penalize you as the client to do that. So you want to make sure that there's some sort of separation between the initial contribution and that Roth conversion, to make sure that the IRS doesn't, treat those as a single contribution. There's unfortunately no like safe harbor. Some people say, oh, you have to wait a year for it. Some people say you just have to wait for one statement of your IRA just to show that the contribution went in there at once. There's no real set thing that says this is the thing that you have to do. So when you're making that recommendation to a client, you're interpreting that in some way. And that to me is you're doing some tax advice there. You're saying, okay, this is what is going to be safe for you to put this money in the traditional IRA before converting it into Roth. Saying that's a year, saying that's 1 quarter. I think that is giving some kind of tax advice. It's relatively low stakes. Again, we're not talking about huge dollar amounts here with the Roth IRA. It's $7,000 a year, and they might owe a few $100s in penalty if that backfires on them. But again, I think you as the advisor, advisors who are doing these kind of strategies, they should be aware that they are taking on some liability, because they are really giving some form of tax advice in saying this is how long you should wait. So that is where you get into the advice part of it. And you may, if you don't want to give advice, you might want to have a CPA give that recommendation, or EA, or some tax professional making that determination of how long you should wait. And again, implementation is doing the actual money movements, making sure they're done according to plan, and also, again, making sure that the contribution is reported correctly. Form 8606 usually needs to be filed, and making sure all those properly get reported on the client's tax return. Again, may need to loop in the CPA regardless to make sure it is actually reported correctly. I finally want to talk a little bit about a final sort of case study on charitable contribution strategies. So again, we have a planning component of this, an advice component, implementation component. You might look at different types of contribution strategies. There's a lot of ways people can contribute money to charity, all of which have slightly different tax consequences. If you're doing just a straight cash donation, you might be able to deduct that as an itemized deduction. If you actually are itemizing deductions, if you're donating appreciated shares, you also might get a deduction for that. Also, you get to avoid the tax liability of selling those shares and incurring the capital gains from that. If someone is over 70 and a half years old, they can make a qualified charitable distribution from their IRA. So there are a lot of different options, and you may want to compare those different options if the client says, hey, I want to give money to a certain charity. What's the most tax efficient way to do it? Your planning phase of that is just comparing those different options and saying, here is the tax impact of one versus the other without coming down on a, here's the thing you should do. Because that's when you get into advice. You're saying, what's the best method that we're going to use? You say, here are the shares, the lots that we're going to donate to charity to make sure you get the best tax impact. That is where you're actually giving advice as the advisor. So if you don't want to give advice, you want to stay with the planning side of it, just the comparison. The implementation, again, is the doing the actual movement of the shares. Again, involves making sure that the transaction is also reported correctly. I keep coming back to this because I think it's a little bit underrated or underappreciated, the importance of not only making sure that when you're doing a tax strategy, when you're recommending a tax strategy, that you actually follow through with the actions themselves, but also making sure that they're reported correctly on the client's tax return so they actually get the tax benefits. This often gets missed more and more than you would like to think. So just making sure that you know that. So I think it makes sense to have a bit of a framework of how you're communicating with your clients, especially if you are not giving tax advice, especially if you want to stay in the planning domain. Because at the end of the day, clients want our advice. Clients, you are making financial recommendations to the client. The client sees you as their financial advisor. If you're not giving them advice, they might be a little bit confused. If you're saying, I'm not giving tax advice here, they may be like, why are you not giving tax advice? You give me advice on everything else. So it's very important to set up those expectations for clients in advance. So before you are giving any advice or even discussing a lot of these tax recommendations, it's really important, I think, to define the scope of the advice that you're giving. So it's not a surprise when you come to the client and say, hey, let's talk about all these great tax strategies. Oh, but I'm not giving advice. And that leads to some confusion. So making sure that not only in the client engagement, you're defining the scope of the advice that you're giving and saying, basically I can't give you the actual legalese, but essentially saying in your engagement, your client agreement, that you're not giving tax advice, making sure that's very legally straight out, because that is, again, that's a legal document with your client. So at least at the very, very minimum, making sure that that's laid out in the agreement. But it's also important to, I think, make those expectations explicit for your clients at the beginning of your engagement, to make sure that, again, it's not a surprise to your clients when you're coming to them and saying, I'm actually not giving tax advice. They want you to give that tax advice. And so making those expectations clear really upfront at the beginning of the engagement avoids that possibility of the client hearing tax advice when that maybe is not actually what you intend to give. When you're actually doing the advice or doing the tax planning, if you want to steer clear of advice, again, it makes sense to keep that focus broad. You're really looking more in broader strokes when you're doing planning versus advice when you get a little bit more concrete. You really want to emphasize that plans can change. If you say this is the thing that we can do 5 years in the future, you want to make sure that the client knows that things can change that mean that might make that different 5 years in the future from now. And then, of course, just important to, when you are only doing the planning, making sure that there is a tax professional, someone that the client can go to actually get the final sort of recommendation. It's great to have someone to loop in that, you can sort of be together on those conversations. But at the very minimum, if you're not giving tax advice, if you're saying we're just doing planning, making sure that there is someone that the client can go to get that tax advice. And finally, following up from the meeting, just making sure that there's any sort of agreed actions that are outstanding, if there were any, that the advisor follows up on those actions, because any action is something that the advisor takes responsibility for, that they're accounting for. I think those recommendations to consult with a CPA, that's sort of included in that. So if you're saying, hey, I think we should connect with your CPA on this, actually start that conversation. Make sure that that is a follow-up task, because if you're dropping that, then that often means that those tax planning strategies, they never get followed up on, they never get followed through with. So if you're doing that recommendation to consult a CPA, it's not just a, hey, this is off my plate, I'm not going to deal with this anymore. That's more of an invitation to continue that conversation with the CPA, and making sure that that's a follow-up task is important. So we are getting close to our time here, and so I want to leave some room for questions here. But just some final thoughts is that, really at a high level, whether you're doing tax planning or you're doing the full advice, you're still about adding value as a client. There's a lot of value in that tax planning, of starting the conversation and just factoring tax impact on the strategies that you're recommending. If you do the advice, that's great, but you really need both of those things to be able to provide the value of good tax advice. If you are at a firm where there's some questions on what your compliance department will allow, I think it's really great to be able to work with your compliance department to actively come up with a definition of what the advisor can do that's just beyond, oh, we can't give tax advice. So maybe you are defining the scope of where planning and advice kind of are separated from each other. Define those parameters, and talk to the compliance department about, like, where is that handoff to the CPA actually supposed to happen? Can we come up with some specific numbers? Do we need to keep it to round numbers? Where should we actually say, okay, you need to go farther from here to someone else to get advice on this? Maybe you are saying, okay, you can give advice on some specific strategies. Say, these are your white list of strategies. You can talk about Roth conversions. You can talk about charitable donations, but don't get into syndicated conservation easements or listed transactions and stuff. Just define what is in bounds and out of bounds, so that everyone knows what sort of the liability that they're taking on is, so that they can then control that liability. Develop your tax expertise. Again, it's easiest to avoid liability when you're competent and have a lot of education and a lot of knowledge of the strategies you're recommending. Becoming an enrolled agent, again, the tax credential matters less unless you're actually doing tax returns and representing clients. The tax credential matters less than the actual knowledge you gain in getting it. You get a lot of good knowledge of tax law. It's less focused. It's not really focused at all on tax planning, but it does give you a good foundation of tax law knowledge, getting the enrolled agent. There's some great credentials out there. The relatively new tax planning certified professional, TPCP credential. Shout out to Jeff from earlier, who led up that designation. Is a great credential for learning great comprehensive tax planning strategies for both for individuals, for business owner clients. Is a great start on if you want to get into tax planning. And then if you want to go even deeper, going getting a master's in tax or a master's in financial planning with a tax focus can really get you specifically deeper into some research techniques, as well as doing some business corporate tax planning if you're going into that way. And also just making sure that you are connected both with other tax professionals, other tax forward advisors. I think estate planning councils that you see often locally are really great places to start with talking with other tax professionals, doing some networking there. FPA has a great knowledge circle around tax and estate planning. So just connecting with other people who share those interests, and maybe you can bounce some strategies off of and find some people to make recommendations when you're not comfortable in doing so. So with that, I want to leave a little bit of time for questions, but thank you so much for joining me today, and for ListPlan for having me. And I'm happy to take some Q&A now.
All right. Thanks, Ben. That was awesome. I
Thank you.
mean, by far, that is the biggest burning question that so many advisors have, is where do I draw the line, and is it okay? And what I heard from you was a resounding yes, it is okay as long as you do the whitelisted tax advice strategies.
Yeah, that's correct. I mean, it's really, again, it can be a blurry line, but I think the question you have to ask yourself is, you know, am I interpreting the law in any tax law in any weird sort of way? Is this a strategy that, if I talk to five other financial advisors, would they have all heard of it? You can sort of ask yourself, is this just something that's straightforwardly within tax law? You have to know something about tax law, obviously, to be able to determine that. But if I go into a specific section of the tax code or regulations and say, oh yeah, this is where it says I can do that, and it's pretty clear that that's what that's saying, then yeah, it's something that's not a problem for you to recommend. You just need to make sure you're owning the liability for doing it.
Yeah, and I love how you broke it down between different segments. Like if you work at a broker dealer or a wirehouse or you're independent, like those have different caveats that you need to be considerate of.
Yeah, exactly. I mean, if you're working at a bigger firm, it's one thing if you're a solo advisor, you can really just choose what you do as long as you have knowledge of the liability you're taking on. But any sort of bigger firm where you've got a compliance department and, hopefully there's some amount of setting policies of what you're allowed to do or what you're not allowed to do, but really it's dictated by what your firm says you can do around tax advice.
Awesome. All right, so we don't have time for questions. We are at time, but I just want to end with two things. So one, a great comment from Leslie Beck. She said, "I don't understand how anyone can do true financial planning without doing tax planning." We agree with you. And
For
then
sure.
lastly, I would love for you guys to show Ben some love in the Q&A. It is really hard to do presentations, and we had a great audience today, and so we have over 1,600 people on the call right now. So show him some love if you appreciated the session. And with that, thank you, Ben. We really appreciated having you here, and we'll have to have you back sometime soon.
Yes, thank you. And I'm sorry I wasn't able to get to too much in the way of Q&A. But if you do have questions, something burning, please feel free to shoot me an email or find me on LinkedIn. Shoot me an email, ben@kitces.com. I'm always happy to have these conversations and know what talk to advisors about what they're doing around tax planning, because it helps me talk to all of you about what advisors can do, what the big questions are. So thank you so much for having me.